Hello everybody, welcome to the Thursday, August 22nd, 2024 edition of the Financial Thing live stream. Hope you're doing well. How is everybody? I'm a little tired today. It is cloudy, gray here, but still about 30 degrees, so can't complain. As I see in the comments, Hurricane Ernesto is approaching the British Isles. Harley is prepared for nothing more than sleeping. It's very interesting how a storm that started in Africa, off the coast of Africa, has looped its way entirely from Africa to the U.S., well, close to the U.S., up through Bermuda, and now completely circles back, and here is Ernesto. Looks like it's going to drop some serious rain on the UK, but nothing new, huh? The UK is very used to rain. Looks like Scotland might take the brunt, whatever that is. Maybe some wind, but not too bad. I don't think it's going to be too bad. Anyway, welcome. Don't forget, next Thursday, 7:30 UK PM. There it is. Oh gosh, who's that guy? Peter Reed will be here live from Assets Exchange. I always want to say Assets Capital. Assets Exchange. Yeah, he says he got some exciting things to share with us, so don't forget to be here and bring your questions. Peter is always very open to answering that. And we are going to get Narinder from Cufflink rescheduled for September. Just waiting to hear back from his what his schedule is going to be like. But in the meantime, of course, Cufflink is the sponsor. Let's get the graphic up. They are the sponsor of this Financial Thing YouTube stream, quite graciously. And don't forget, if you are not a Cufflink account holder, which I know most of you are, but for those who aren't, you can get up to 10.25% gross interest per annum, over £330 million invested since 2016, zero investor losses to date. Capital is at risk. Please don't invest unless you're prepared to lose money. Please check rates on Cufflink's websites as rates do change. You can sign up at join.cufflink.com/financial-thing or use the link below. Very important, don't invest unless you're prepared to lose money. We have, some of us, lost money in peer-to-peer lending, and other forms of investing is always a possibility. Nothing is guaranteed when it comes to investing, and Cufflink is no different. But you can get that nice little 1-year fixed rate right now, 10.25%. So go check them out. So what are we talking about tonight? We had a little bit of peer-to-peer news, and I'm going to look at one of the loans inside of LonePad's loan portfolio that was put out, I think, on August the 9th, if my memory serves me correct. We'll just take a quick look at that, see what's on the Cufflink platform availability. And we're going to take a mailbag question about retirement. I think it's a really, really important subject that is often overlooked, especially for people who are younger. I know most of the people who watch this stream are probably 40 years old, maybe and older. I don't know too many that are younger, but as we sort of approach those retirement years, I think it's a very, very overlooked piece of information that younger people do not get spoken too much about these days. There is better information than was when I was a youngster because of the wonders of the internet, but still it's a topic that I think is super important. I got an interesting email back in July about it, so I'm going to show you that. We're going to talk a little bit of Bitcoin. We'll look at the stock markets, look at the Trading 212 portfolio. And if you have anything that you want to touch upon, pop it in the chat and we'll talk about it. This is not all about me. This is as much about you as it is about me. And sometimes I don't know what it is that's the best thing to talk about, so I just try to give you some topics that I think are interesting and that will keep you coming back. So I appreciate you being here. Quick hi to everybody in the stream. Dave Dawson is here. Peter Vince, Weatherman in Leatherhead, where it's dull and grey. Colin Perry in the Peak District. Stephen Hale in Nottingham, of course. Alan Stratford is here, as always. Stephen Hale, cloudy and grey in Nottingham. Paul New in Stockport. Anna Bornarian, not in sunny Spain as she usually is, but in soggy, windy Sussex. Ugh. George Batchelor is here in Bridlington. I love that name. You know, my girlfriend and I were talking about how the USA has a lot of the same town names as the UK. And we were looking in the New England area at the map, and we just saw so many names that are the same as they are in the UK, all the different villages and towns. It's pretty cool. Anyway, Bridlington sounds like a really cool place. Let's get right into it. I'm going to try to speed through this tonight so you can get back to doing something else. Go to the pub, watch the football. I don't know, whatever it is you like to do on a Thursday evening. Let's talk about capital rise. In the news, here we go. Capital Rise reports a record July and a 32% annual growth in their live loan book. That's pretty big. Capital Rise enjoyed a record month for originations in July. Nearly £50 million of loans agreed. That is a big amount for 1 month. The prime property investment platform says its July activities bring its cumulative origination above £400 million to date. I think they're going to be over half a billion within the next probably 3 months. The growth in lending has been supported by several new funding lines agreed earlier this year, including a £250 million facility in January, a 50% expansion of an existing funding line in March, and a new £30 million funding line in June. Obviously, Capital Rise has a lot of loan demand, so they went down the institutional route to expand their credit lines because, as a lot of peer-to-peer lending companies find out, they don't get enough. They just don't get enough money from retail sometimes, so they have to take it from institutional lending, which is okay. It's good to have a backup plan. Continuing on, the platform has reported a 32% year-on-year increase in the size of its live loan book, although no value was disclosed. I keep meaning to reach out to Uma, who I did get to do a Q&A with a few years ago live in person. I don't know if you've seen it, but if it's archived on the Financial Thing YouTube channel that her and I had to sit down. Usually a lot of these things I don't get to do face-to-face, but she was one of them who invited me to their event. It was one of their, I think, launch events, and we got to sit down and have a chat about their business. So it was a very interesting chat, but I would like to get her back on the stream. I'm sure she would do it if I reached out. Note to self. So Capital Rise continuing to grow. And it's funny because, these companies that sort of in the background motoring along, peer-to-peer is in this kind of very, I would call it sleek, kind of covert state right now. You don't really hear a lot about these companies in the national news. A lot of people just still don't even know that peer-to-peer lending exists. In fact, if you Google peer-to-peer lending in the UK, I don't know if you could see that, but basically a lot of the first things that come up are just very generic articles. You got a few articles from the Alternative Credit Investor. You got a couple of Forbes things on there, but generally you just don't really see that much new information. You can see these articles are old. 1 month, April 2024, 1 month old, February 2024. So peer-to-peer continues to sort of just fly under the radar when you can invest through companies and make a pretty decent return. I just don't know if is it growing? That's the question, or is it the same investors who are piling money in because they now feel comfortable? I know there's an article on Fourth Way about the remarkable long-term performance of peer-to-peer lending. I thought this was an interesting article. I'll just kind of touch on some of the things you probably already read it. But this says in the article there's consistent outperformance of the stock market. Fourth Way's most precise data set measurement are over half of the lending volume on the market over the past 10 years. Peer-to-peer lending has outperformed shares by over 2 percentage points per year after costs. Those doing peer-to-peer lending have typically more than doubled their money in a decade, half again as much as share investors whose pots have grown by less than 2/3 in that time. Peer-to-peer lending has had no down years and only a year where it lost somewhat to inflation, although lenders still earned twice as much as stock market investors during that year. At the same time, the stock market roller coaster had 3 individual down years for after inflation. It took some share investors more than 6 years to get back to where they started. The reason for the stability: money lending is intrinsically more stable than owning shares in companies because as lenders with property security, investors usually get their money back first, whereas shareholders are the last to do so when things go wrong. Indeed, even without any security, money lenders usually get their money back before owners of assets like shares or property. Furthermore, assessing a basket of borrowers is much easier than appraising the future profitability of a basket of businesses. What about the bad eggs that close? So talking about funding secure and lending, etc., etc. The vast majority of closed peer-to-peer lending providers wound down profitably for lenders, and yet there were also some truly bad eggs, such as funding secure and lending, as there always are in investing. While we're not able to get the sort of data assets we need to properly integrate companies that have closed into our core performance data set, we have sufficient data to make good estimates. If we conservatively include their write-offs to date and even added onto that their probable future losses still to come on outstanding loans, the grand sum of all losses from all bad eggs would have been surprisingly small impact on overall lending results. Indeed, pulling all those losses into just 1 year that funding secure and lending actually shocked many observers by closing down. The interest earned in good peer-to-peer lending accounts in that 1 year alone would cover all those losses with something to spare for lenders. That will leave all the other years as pure profit. I think this article is kind of somewhat flawed because it's making a lot of assumptions about a lot of things that I don't think you can really measure. For instance, if you take the people that invested early in peer-to-peer lending and they were invested in all 5 of the companies that went bad, then that section or subset of peer-to-peer lenders is going to have really, really bad results. And it would certainly take them a really, really long time to recover an 80% loss if they had money in, say, Lendy. If a lender had put, say, £10,000 into Lendy and was only expected to get 20% back, so they make an £8,000 loss, how long is it going to take that lender to get £8,000 of interest back from a peer-to-peer lender? And if you take, say, a 10% return on 10,000, you're talking about, I don't know, compounded maybe 6.5 years to get that £8,000 loss back, maybe more, 7 years. That's a really, really long time to rebound. And I think the problem is that there is no index fund of peer-to-peer lending. Now, wouldn't it be nice if there was one fund you could put your money into that, lent out across the entire peer-to-peer space, all the different loans for all the different companies to really diversify and reduce risk? Unfortunately, that doesn't exist. So this whole idea of, peer-to-peer being a 1% rate return doesn't play into really anybody's investment strategy, because nobody would be putting all of their money into every single loan through every single peer-to-peer lending company. So quantifying exactly how individual lenders have done is a lot different from looking at each different company and saying, well, that company returned 5% for the last 5 years. Because, lenders are not doing that. They're picking out their own loans in some cases. They're choosing X amount of peer-to-peer lending companies, maybe 5 out of 40 available. And some people have taken some really, really bad hits. So This article is, well, I think is interesting. I think it's kind of flawed. It puts out a definite spin in favor and bias of peer-to-peer lending, which I would imagine, of course, Fourth Way focuses on peer-to-peer, so they're going to be very positive and rosy, looking about returns. But if one were to say, what would you feel more comfortable doing? And if I were to ask you this question, I think I know the answer. Would that be to put X amount, all being equal? If I said to you, would you feel more comfortable putting 100% of your investable funds into peer-to-peer lending, or would you prefer and feel more comfortable putting 100% of your investable funds into an index tracker? I hate to say it, but myself, it would be the index tracker, because there's just too much downside risk of peer-to-peer lending from historically what we've seen. I know my index tracker is not going to go to zero. I can almost 100% bet on that. But I couldn't 100% say that my peer-to-peer lending funds wouldn't take a massive hit or possibly go to zero if I picked the wrong companies. So going back, I don't know. This is an interesting article. I do find Fourth Way, I know they're good at taking data sets. Sometimes I think these articles are a little bit off. Now, finally, this wraps up and says, looking further back in time, you'll see why peer-to-peer lending is still a thing, not a fad, which I believe that's absolutely true. While we can't extend further back than 10 years with precision due to the particularly stringent quality standards that Fourth Way imposes on performance data, we still have sufficient data on almost the entire historical market to see that peer-to-peer had positive returns every year since it started in 2005. Yes, that is, again, if you took the entire peer-to-peer market and averaged everything in, yes, I'm sure those returns will be positive. This compares with 6 years, down years for the stock market, 7 after inflation, which includes 2 completely separate periods of time when some investors would have taken more than 6 years to recover their losses. I think the only fair way to compare the stock market and peer-to-peer lending as 2 different wholes would be to have some kind of peer-to-peer lending index tracker, which allowed you to invest in every single loan in every single company and see what those final percentages is. And, there isn't a way to do that. So it kind of renders this article a little bit defunct, I would say. What do you think about the article? You think it was a good one or full of it? I thought it was interesting. We had some news from LonePad finally about this big upcoming software upgrade that we have heard about from Louis, from LonePad CEO. By the way, check out the interview, check out the Q&A, the live stream that we did with Louis a few weeks ago. It's on the channel, archived. LonePad is updating its software. This was August 14th. I got this. We've taken this decision in order to make the site even more user-friendly for our investors and to ensure that we are up to date with the latest development standards in the industry. We hope this new version will improve the overall site experience for our users and allow us to implement future updates more seamlessly. How will the software update affect investors? There'll be no significant change in the way that investors use the LonePad platform. Our users will still be able to access their profiles as usual and allocate funds in the usual way. However, the look of these pages will change once the new software has been rolled out. It seems like there's going to be a new user interface, maybe, the way that the platform looks. Hopefully they don't take away some of the simplicity that I've really come to like about LonePad, but improvements are always good. Neil Maurice, who is the Chief Operating and Financial Officer at LonePad, says, we have built the foundations of the back-end architecture in order to speed up processing times and enhance the user interface. And for us, it's about being able to be nimble and able to make the most out of the modern tech. What we're building now allows us to bolt on new solutions and build something really lean that is representative of the LonePad brand. Users will see a different interface, but the actual day-to-day stuff won't change massively for them. The software update is currently ongoing and is set to be rolled out by the fourth quarter of 2024. So what we'd be talking about possibly September, October time. What will be different on the new site? There'll be more self-service features. Once the update has been released, investors will be able to take more control of their account settings, etc., etc. For example, users will be able to set a wider variety of interest preferences, such as reinvesting their interest or auto-lending all available cash, change their phone numbers, email addresses. There'll be a new smartphone app, which is cool, new profile page, streamlined onboarding, so if you're a new customer, the onboarding process will be more streamlined, and then biometric ID checks. Now, what this does not mention is the big question of whether we are going to see this £10 maximum, £10 minimum for reinvestment now going down to a penny, which is kind of what we've been promised for a long time. So right now it's still £10. So that is, I think, going to be probably what most people really care about, is will their money get invested straight away instead of waiting to hit that £10 in interest before being deployed. Pretty cool, though. It's really good to see that they are finally going to be rolling out this software update, which I thought was going to happen at the beginning of this year, but it definitely has taken them longer. Software does tend to take longer for sure. What else? Let's take a look at LonePad's loan book right now and take a quick look at one of the deals. I was kind of poking around to see what the availability looks like within the peer-to-peer lending world. And I'll show you first of all Cufflink. Now, Cufflink has usually got quite a few deals on their website to invest in on their self-select, but right now it's pretty quiet. There is only one opportunity, which is the Blandford Way UB4. There's two tiers of that. You can get 8.5% gross or 9.06% gross interest depending on the tier you take, but otherwise from there everything has been filled. Now what that means is there is more lending money out there, so more demand from us investors than there is deals. LonePad also, and they continue to add loans to their inventory. So if we take a quick look here, this is my particular loan book, and what I did was search by repayment date just to see kind of where the loans were looking to be repaid. So if we scroll the way down to the bottom, you see that some of the loans are going to be repaid in September, and we have a couple of new loans right here that were written this month. Which one? Let's look at 9486370. This is actually a pretty decent sized loan that was commenced on the 9th of August 2024. So LonePad Senior Tranche, £1.4 million. So pretty decent sized loan. It's located in Ealing, Greater London. I'm not exactly sure where, because I punched in the address on the map, but it did not come up. But you can see this is map of London, central London over here. So we're west. Is that, wait, no. East, yeah, east. Is it west or east? East. What am I thinking? Never eat shredded wheat. It's west. It's totally West London. I was trying to find it on the map, but Northfield Avenue is a pretty long avenue, so it looks like it's going to be some kind of a flat redevelopment over there. 1.4 million. It doesn't say anything about how much interest this company is paying for this securitization loan, but it says 12 flats in total. First legal charge over 6 contained 2-bedroom flats forming a part of a 6-story mid-terrace block comprising of 12 flats in total. So they've got the first legal charge of 6, loan to value below based on the full LonePad allocation of £1.425 million from a valuation report of as of the 19th of March. So LonePad's open market value is 47.5%, and a 90-day sale 52.78%. So a little bit higher than LonePad generally tends to go with their loan to value, especially if you use the 90-day valuation. So what that means is if they need to sell it quickly within 90 days, £2.7 million valuation. It would be a 52.78% LonePad loan to value. So LonePad continues to write new loans, which is what we want to see happening, and they continue to trend in the right direction. But yeah, Cufflink has been, I don't know if they're still working on bringing on new loans into the platform, but their select is looking a little slim at the moment, but I'm sure that will change. Assets Exchange released a new feature, monthly withdrawals. Again, don't forget, you're going to be seeing Peter Reed live next Thursday, 7:30 p.m. right here. We'll do a Q&A session with him. But following a number of investors' requests, we have added a new feature, monthly withdrawals, that allows investors to have an automated opt-in withdrawal request for them once a month. Monthly withdrawals can be activated by selecting Manage Funds and then Withdraw on your dashboard and activate for the required account. When monthly withdrawals are activated, an automatic withdrawal request will be generated if an investor has a minimum of £30 in their account on the first working day of the month. Monthly withdrawals can be activated for both regular and ISA accounts independently. The withdrawal request will be for the investor's entire cash balance in that particular account, and the request will be processed to be distributed to investors the next working day. So it seems like if you have money sitting in your account as say you have cash that you're sitting waiting to deploy, that would actually be withdrawn all in one lump. So you may not want to turn that on if you are leaving money in there to try to invest in Assets Exchange loans. Usually what people use this for is if they have all their money deployed and they're getting some interest back out and they want to get interest monthly. You'd have to have a pretty decent amount of money in there to get £30 of interest each month. But just bear in mind that it will take out everything. I think once a month that is sitting inside the holding account, but still a cool new feature. See, Crowd Property put out a market takeaway. They're saying house price growth will hit a new 2024 highs. So that's pretty cool to see the house prices still continuing to go up. And I think those interest rate cuts should help that because people will continue to borrow. Construction activity accelerates at the fastest pace. July was a positive month for UK construction, with activity soaring at its fastest pace in 26 months. So you can see here it's trending on the uptick. Good for peer-to-peer lending. More specifically, total industry activity rose sharply to 55.3 in July from 52.2 in June. What else? MPC makes long-awaited base rate cuts. So Monetary Policy Committee, of course, the very small 0.25% rate cut. Let's see, anything else? EY's summer forecast shares bright outlook. So they're saying that the summer forecast for gross domestic product growth being predicted to reach 2% in 2024, 25 and 26, inflation averaging 2.5%, this year slowing to 2.2%, if you believe that, and a further Bank of England bank rate being cut to 4.75% by the end of 2024. I certainly think that is very possible too. So all of that is looking good for house building and peer-to-peer lending market in general. Crowd Property still continuing to put out new loans and move forward. Interesting piece of news, the FCA has fined PwC over London Capital and Finance failures. Of course, that was that massive bond failure in 2019 where LCF owed over £230 million to more than 11,500 bondholders. Another reason why you be very, very careful if you're ever investing in these bonds that are private bonds. Very, very risky. Basically it's a firm, an auditor that has gotten fined £15 million for not acting on red flags when it audited LCF. So the FCA has slapped them on the wrist. First time ever that it has fined an audit firm for not spotting things that it should have spotted. So I wonder if they had insurance to prevent that from happening. Very crazy. What a big debacle that was. Whew. That's been a complete mess. Thankfully, some people did get their money back, and it is what it is. Things happen. It doesn't just happen in peer-to-peer lending. It happens in all facets of the investing industry. Things go bad. Let's take a look at the stock market, and then we'll look at the trading 2-on-2 portfolio. I did add a position this week. Had a bit of a rough day. I was expecting actually yesterday that the markets were going to nuke because of this really bad job report that came out. The U.S. added 818,000 fewer jobs than thought, adding to concerns about the economy. This came out yesterday, and the stock market did not react in any way to this news. I mean, this is a huge piece of news. Originally, it was supposed to be 2.9 million was the predicted jobs, right, in the U.S., and that was almost a 40% revision down to 2.1 million jobs were created within the last year. So they were 40% off on that prediction, and yet the markets yesterday did not react whatsoever on the 21st. You see here what happened. Today we've had a bit of a dip. I don't know why this says the 21st. Isn't it the 22nd today? Why is it saying the 21st? I don't know why it's saying the 21st. But the S&P 500, we've had a bit of a dip today. It's about 0.75% lower. Started off not too bad and then dropped throughout the day. Trading 2-1-2. We're at 21,317 pounds. We were up to about 21,600 yesterday, but we've had a pullback, and we got a new position here in Amazon, which is trading right now at 177 US dollars, which is 136 pounds, down a little bit, about 0.8%. I think the Amazon is trading cheap right now, and we'll see when their profits come out. I think this stock will have an uptick. It's kind of more of a way to deploy money into something that I think is not super risky, while trying to find other spots to really put this money to work. It's got a little bit of cash now. We're at 3,300 in cash, so majority of the money is deployed, which should make the portfolio a little more volatile, but hopefully ride those highs. We're going to have a big speech tomorrow from Jerome Powell. He is in Jackson Hole, Wyoming, meeting for 3 days about monetary policies. I'm almost positive we're going to see a rate cut at some point coming up soon. And I think when that happens, the market should take off like Elon Musk's SpaceX rockets, but we'll see. Advanced micro devices were up 6%, 6.3%. Coinbase still up about 18.9%. Had a pretty up and down week in the crypto world. Creative Realities trying to trade this stock, but it's not really playing ball. By the way, don't trade stocks. It's not a good idea. Nvidia is our biggest position right now. We're at almost 5,600 pounds of holdings in Nvidia. The earnings report comes out on the 28th of August. I'm expecting a big one, and for this to really shoot up. We'll see if I'm right. Rivian, this is the stinker of the portfolio right now. Probably going to eject this. I have a sell order in here. Let's see. Do I have it? I thought I put a sell order in. There should be a sell order in for about 15 US dollars. If it hits 15, I think this one's going to end up getting ejected. Not really feeling good about the whole electronic vehicle market. I'll show you why in a minute. And what else? Valco Energy still doing well. And then we got our little S&P 500 tracker ETF here, which is up about 3%. So all in all, the portfolio is still continuing to, I think, go in the right direction. Rivian, I thought at one point was going to be a good position. But I've been reading stuff like this. Half of U.S. electric vehicle drivers are considering switching back to gas vehicles. I mean, that's not good when you read things like that. Vehicles in the U.S., EVs don't make a lot of sense because of the much bigger ground that has to be covered, and the lack of really charging infrastructure here is just not great. But then you see this global study. They did a global survey of 30,000 respondents in 15 countries, found that more than 1/4 of electric vehicle owners are likely to go back to driving gas-powered cars. Australia topped the list with 49% confirming they want to return to driving behind the wheel of a petrol and gas-powered automobile. The lack of public charging infrastructure was the chief reason respondents wanted to switch back to gas or petrol-powered vehicles, with 35% saying it's not yet good enough for me, and 34% noted the total cost of EV ownership were too high. And there's a lot of reasons for being disappointed in electric vehicles. We can go into that, but one of the reasons, why I'm thinking originally I was thinking the Rivian was going to do well because of the contract they have with Amazon. And they have a lot of electric delivery trucks out there, but it just seems to me like the retail side of things are not going very well, and they've had some issues with their production, some shortages too. So I don't know. I just think when you're trying to trade in a portfolio like this, sometimes you just got to get rid of the losers and try to catch on to the faster moving stocks that are going to propel upwards. But again, this is not a very good long-term strategy. And I bet probably if this was a long-term portfolio, this Rivian wouldn't even be in here. Probably a couple of these shares wouldn't, but this is not. So that's why my feelings towards Rivian are turned definitely more negative. Moving on, because it's 8:07 p.m. in the UK. Put your comments and let me know what you think too. We got a letter in the mailbag. Hi Lawrence. First off, thank you so much for all the information you make available. Very welcome. I've learned so much about investing over the last couple of years. I'm in my mid-40s and didn't start investing until 2 years ago. Sounds like my story. Now I'm starting to think about future planning and retirement. I find all of the information on the internet quite overwhelming. Everybody seems to have different advice, so I thought I would email you. I'm gravely concerned I will not have enough money to ever retire comfortably. I make about £62,000 after tax per year. I have about £110,000 in my pension pot. I'm diligently saving to grow that number. What do you think would be a good plan to reach retirement? I know this is a very broad question, but having some sort of basic plan will help me immensely. Also, when I do finally reach retirement, should my investment strategy change at that point? Finally, should I go see a financial advisor for planning and investment purposes? Again, thank you for any advice you can give. Regards, Pete in Warwick. Pete. There's a lot of questions in there. I'm going to go through it as quickly as I can, try to answer those for you. It seems like you make a pretty good income. You don't really say what your expenses are, so it's really hard to comment. But, I mean, it's kind of the basic strategy for retirement is cut your expenses where you don't need to spend money on things you don't need. Put that extra money away towards your retirement. Use an ISA for tax reasons, obviously, where you can. If you have any other ways you can use tax for your benefit, do that. That's the one time I would say maybe speaking to a financial advisor is worthwhile. For planning purposes, you can speak to an accountant or an advisor about tax things, but generally you'll ask questions, should I go see a financial advisor? For investment purposes, for investment, I would say probably not. You don't need it. You're still relatively young. My investment strategy for retirement would be the same for you as it would be for a 25-year-old, which is use an index tracker. It's very simple. I like this one, the U.S. Equity Index Fund, which you can get through Vanguard UK. Fidelity has one similar. You can also use a global index tracker if you want one fund that you put your money into. You do not want to do what I'm doing here with these single stocks. You will fall behind the indexes. through your losses because you're going to pick stuff like I did with the Rivian, which is in the red, and other stocks that I have done in the past that have taken some nasty hits. Use the tracker. Tracker is absolutely the best way, I think, to get to retirement. There is let's see if I have an image. Let me pull it up for you. This would be kind of my retirement pyramid. If I was, I call it an investment pyramid because it is, I think, a pretty good way to sort of set things out. I made this especially for you, Pete. You can see here the risk arrows. This is my personal opinion. Some people may think that some of these items would go in different positions, and this is not how much you should allocate to each individual thing. I put this in a risk of green, the lowest, to red, what I think would be the highest, from the way most people would think about it. Again, I may move these up and down a little bit. For example, I don't think Bitcoin is actually as risky as being in the top tier, but most people do. So emergency savings at the bottom, 6 to 12 months of living expenses. I think that's everything somebody should have. Most people tend to go for 6. There are people that I know who do 3 months of emergency savings. If something happens, you lose your job, you got at least 3 months to keep on your feet. Also, if you have stocks, you can always liquidate them if you need to in an emergency. So I don't think sitting on a big pile of cash is really necessary. Next, you got your fixed income. I would say this is more important in retirement years than now when you're working. You can use things like rental properties, savings accounts to give you, interest. But the problem with savings accounts, the interest rate is going to drop. When it starts to get into that 3% range, you're barely beating inflation. But it's always good to have a little bit in savings. Some people, especially people in the UK, like to sit on a lot of cash. I've never really understood that. As long as you can leave the cash invested for 5+ years, I think you're much better than having it sat in a savings account. Whatever that investment looks like for you, that's for you to decide what type of risk you want to take. Then you got this middle tier of risk, I think, heading to retirement. This is where, personally, most people should be putting most of their money. Not financial advice, but shoving it in an index tracker if you want to pick stocks for dividends, etc. That's up to you. You could do that. Personally, wouldn't be my way of doing it, but again, everybody's different. Then you've got your peer-to-peer lending, which I put mixed risk in here, which means basically have some high risk, have some low risk, have some medium, all in a bucket, 5 or 6 companies. That's going to give you a good fixed income. Hopefully in the future when you retire, that acts more like a fixed income product. Then at the top, you've got your higher risk things like investments, gold, silver, collectibles. Gold and silver do fluctuate in price, can be quite dramatically too. Obviously gold is doing really well right now, but there's been periods of time where gold and precious metals have not done well at all and have dropped quite considerably, so they are volatile. And then at the top, Bitcoin is something people like to do to hedge against inflation. Again, that's personal preference. I would put this probably Bitcoin somewhere in the middle here, in between maybe peer-to-peer and investments, so maybe somewhere around here. This pyramid, again, is different for everybody. It just really depends on what your risk tolerance is and what you're trying to achieve. Sometimes when you're a little bit behind in life, you do have to tend to take some of this higher risk to try to get where you need to go, because if you did start in your 40s, you still have time. You still got another, your mid-40s, 15 years, 10 to 15 years. So you might have to take a little bit more risk to get to where you want to go. That all depends on you. Now, would this change for you when you hit retirement? How much you put into each of these allocations? I think so. I think a lot of people in retirement will want to have a higher amount in fixed income and not take so much risk in their investment side in the stocks and trackers. For somebody who is in their mid-60s and needs the money, probably having 100% of your entire net worth invested in an index tracker is bad news, because if the markets were to crash by 30-40%, you woke up and saw £1 million of your stock portfolio now sitting at 600 grand, I think you'd feel pretty sick. So I would say in retirement, you probably want to have some more peer-to-peer allocation and more fixed income. I wouldn't have too much in cash. I think inflation is just going to suck up your cash. So more peer-to-peer, more fixed income, less in trackers. You could possibly use a bond fund if interest rates are okay. And then, still continue to have this allocation of higher risk, but maybe a smaller percentage of your portfolio. You can definitely get there, though. You're better off than some people I've seen who in their mid-40s don't have hardly anything in their pension pot and are really relying on the government pension to make it through. So I think the key is just to throw as much as you can. Now at your age of this salary, hopefully your living expenses are manageable. That's the one biggest mistake people make is, they've got the nice car, they're paying £400 a month for their car. They got too big of a mortgage in a house that they can't afford. And then they've got silly expenses that they don't need. But you can cut all of those things down and be smart and responsible. Then you can throw more of your salary and maybe any bonuses that you get at work and just try to build up that pension pot. It becomes difficult when you see stock markets are at their highest level. People come into chunks of money. Maybe you get a £10,000 bonus, and people always get a little squeamish about investing when markets are at their highs because they feel like, it's not going to go any higher, or as soon as I invest, the market's going to go lower and I'm going to lose some of my money. Well, first of all, you never lose until you sell, but you really just have to come up with a plan and diligently follow it through, and know that if you leave your money alone in an investment, hopefully for 10 years, you're going to be pretty happy about it, because markets are always going to reach new highs. You also have to think about how much more expensive things are going to be in 10 years. Everything is getting more expensive. The economy is not great. There's this news article that said 25% of British people are considering turning off the heat in winter as power bills soar. This just came out. A quarter of British households are so worried about their electricity bills they are considering spending next heating season without heat or hot water. That's a survey by the Citizens Advice Bureau. The concern, that's really wild. The concern follows plans by the National Electricity Market Regulator to raise the cap on bills by another 9.2%, equal to £150 increase. So things are just generally getting more expensive. As you hit your retirement years in 10 years, how much is more expensive is everything gonna be? You can see that inflation is still around 3% in the UK. I think it's personally higher. I don't think this is the real news. Oil prices, of course, have spiked in 2011, come back down, but are now at about $84 for Brent crude. You can see new car prices. Look at this. From 2008, these new car prices have gone up considerably on the index points. What is that? 9, 4 is 36. It's about 50% on new car prices. So what is it going to be in 10 years? You're going to need more money to buy things like that. You can see heating oil, too, is on the uptick. 66 pence now for 1,000 liters. So you do have to kind of think about that in the future. That's why it's important to diligently save. And to be honest, a lot of people really don't worry about thinking about how much more expensive things will be. What's inflation going to look like in 10 years? What's that going to do to prices? But the only key is just to put away as much money as you can and hope that you make it to the end. That's it. So that's about the best. I think I covered everything you asked. Financial advisor, yeah, we covered that. Should your investment strategy change? Yes, it probably should. When you hit retirement, you want to go less risk. That's basically it. You can still have some risk. So imagine if you were doing a bond versus stock portfolio when you hit retirement. Probably something safe would be like 60% stocks, 40% bonds, or 50-50 depending on how you feel. That way it's not going to be so volatile. Or something where 50% of your money is in some kind of fixed income product. But yeah, I think you can make it. It's a good question. It's a good question. I don't think we talk about that kind of thing enough. Yeah, oh, and two, if why index trackers, right? Look, even Warren Buffett says he believes in the S&P 500. He says, in my view, for most people, the best thing is to own the S&P 500 index fund. The trick is not to pick the right company. The trick is to essentially buy all the big companies through the S&P 500. That's through the index tracker. Do it consistently and do it in a very, very low-cost way. So, even he, agrees with me. Should we cut it off? I think we've done enough. I think we're going to cut it off there. I'm tired of talking. I think you've heard enough today. I hope you enjoyed it. Don't forget to come back. Come back, okay? Come back next week, Thursday. Let's see. There we go. Assets exchange. This is an old picture, but remember when we used to be in the other room with all the cool lighting? Yeah, come back. We'll see Peter next week. Hi from Kenilworth. Mike Palace here. A couple of aggregators tried something like that. Went bust. I remember that. I remember the aggregators. I can't remember what the name of the company was. Hit that thumbs up if you can. It helps out the stream. Only takes a second. Peer-to-peer has a fairly short history. Not enough for myself to risk too much yet. I'm still learning. Very good. Richard McDougall says the problem is finding enough peer-to-peer that you're willing to invest in and paying a decent premium. You have to wonder 2% premium like LonePad versus 4.5% to protect through FFCS is worth the risk. Well, here's the problem. That number's not going to be 4.5% soon. I think by the end of the year, you're going to be in the threes. So now you're talking about quite a bit of difference. But also, 2% can really compound over a period of years. Believe it or not. It doesn't sound like a lot, but let me see how much that is. Go to my favorite calculator here. So if we shove, let's say we're talking about £10,000, right? Yearly interest 6.5 over 10 years. How much do we end up with? What do you think? 19,121. We're talking about 4.5. That's a £4,000 difference over 10 years. But if we're talking about what I think the rates are going to be, 3.5. Now we're talking about 14,183. So you're talking about a £5,000 difference over 10 years. You start getting into 100 grand. You're talking about major amounts. So 141 after 10 years, 141,000 at 3.5% versus £191,000. So big differences. So 2% doesn't sound like a lot, but actually is over periods of time, which is what retirees are really looking at who are heading to retirement. It is hard to get into some deal. Alan Stratford had tens of repayments from HDR loans, took out Axia funding. Unfortunately, he suffered a large loss, 96% capital loss from a loan that he massively overinvested in. So again, yeah, remember that old adage of only invest what you can afford to lose. Right there, case in point. You are going to have some losers and some winners. I think it's important to stay level with your investment amounts when you're picking out loans. because you never know. More loans, less risk. Agreed. See, that's the problem. Like one loss can really put you so far back. It can literally take you months and months or years to recover in one loan loss. I'm retired. My average month, this is Peter Vince, retired. Average monthly outgoings for council tax, electricity, water, broadband, and TV is less than £1,000. That's good. My state pension is $722 per 4 weeks. I have a good company pension, so I'm comfortable. Annabelle says, seek a tax accountant advice for tax advice rather than a financial advisor. I've lost far more than I've gained through financial advisors. They say £33,000 a year is comfy for a couple to live on in retirement. Come on. 33,000? I don't know about that. It depends where you live, right? You live in London, no. I do not think gold is more risky than shares. Depends what you're investing in. I think an index tracker is a basket of 3,000 shares is personally less risky than gold. Gold is volatile. Go look at the gold charts. There's been times where gold has really dropped a lot in very short periods of time. And what is gold value really based on nowadays? It's not like it used to be. Anyway, yeah, let's get out of here. It's almost 8:30 p.m. Enjoy your evening. Thank you for joining. Hit that thumbs up button. Come back next week. Peter Reed from Assets Exchange will be here live. Harley had a great learning experience tonight. She's full of financial information in her brain, dreaming about it. It's great to see you all. Much love out there. That is all I got. Have a great weekend, okay? We'll see you soon. Take care.